Found out why investing your portfolio based on canned sayings like sell in May and go away is not an investment strategy. Hi, Jim Gore from THOR Wealth Management. Investing your portfolio based on catchy phrases like the presidential election cycle or sell in May and go away is really not an investment strategy. And I'm going to show that here using the sell in May and go away. What is that? That is a strategy that some people espouse, that the market really does nothing over the summer months. And they say you should sell your portfolio on May 1st and not get back in until Halloween, the end of November. So it is a strategy that you're really only invested from December all the way to April. And that's where most of the gains are. It is not a good strategy, but it makes sense intuitively if you look at some factors. What do you look at? If you look at some factors here, especially looking at consumption, I showed this in the last market update we did. Consumption is 68% of the US economy. When does most of that consumption occur? Well, this is not an EKG, but it's very, very informative because this is retail sales every month. And what you'll notice here, every year, you get a spike up in sales in December. Makes sense, it's Christmas season. People are buying. What happens right after that? February, March, retail sales collapse, they go down. Well, we all know that. We're not buying because we got all our gifts in December. But this, when you look at this intuitively, hey, the company's earnings are going to come out in February and March that are going to include those December numbers. So they're going to be good. So the stock should be up. Going out in May and June, their sales are going to go down because cyclically sales go down in that time period. So you don't want to own those stocks with those earnings coming out then. Intuitively, that makes sense. Other thing is intuitively makes sense is looking at some other factors. And I've been in this business for almost 40 years now. And if you look at this, there are some things that occur from a tax perspective. People that pay quarterly estimated taxes pay in April, June, September, and January. So you look at May and June, they have a compressed time period. You have to pay your second quarter payment 2 months after you made your first one. Whereas your last one is 4 months. So it's spread out there. So the thought was, hey, there'll be more of that money invested. There'll be more money going into the market at that time period. The other thought was, hey, 401k deposits. People will go ahead and front load at the beginning of the year, and then they'll catch up at the end of the year. In the middle of the year, there's really none of that going on. Those people that are doing it steadily throughout the year keep it the same. But there are people that say, hey, let's front run it. And there's other people at the end say, hey, I got some extra cash. I got my bonus, year-end bonus, put that in their 401k plan. And then the other one is that, tax refunds in January and April, and then year-end bonuses, that money people have to invest. Now, intuitively, that makes sense. But does that really happen? And now we have some data to show this. And I wouldn't use mutual fund numbers because we're seeing more people are going to ETFs and mutual funds. This is mutual fund and ETF flows. And there's no discernible trend here where you see more inflows going in at the beginning of the time period in November through April, or vice versa. You did have one big dump in ETFs. This is U.S. mutual funds and ETFs back in July. It really didn't impact the market, but you had $285 billion coming out of those types of securities. So the flows don't agree with the analysis that tax payments and bonuses and other things, more money is going into the market. That's not the reason for sell in May and go away. Well, if you did this strategy, and it's something that we would not espouse to do, you would have sold out on May 1st. And you put it into a money market fund. Let's say you put it into Schwab Money Market Fund. You can see that here, the Schwab Money Market Fund, great, you're up 2.27%. If you're in the S&P 500 Equally Weighted Index or the EFA International, you're up 14%. So this strategy did not work well this last year. And two areas that we've been talking about to put for clients to put money into, And I actually did get a call in April for someone that said, hey, put some money in cash, maybe 20%. And I said, why would I do that when I'd rather own emerging markets and gold miners? Look at what the performance is there. In emerging markets, you're up 25% just from May to the end of November. And gold miners, you're up 75%. So the conclusion is here, you had a catchy phrase that someone came up with. They did some analysis and they took out some strange months. Well, you don't do that. You got to use that consistent data. Go away, sell in May and go away is not an investment strategy. We know that here at Thor, we got a very disciplined approach to how we invest that works. Instead of using a catchy phrase, we have our Thor decks, which is what we rely upon. I hope everyone has a great New Year and a great Christmas. We look forward to talking to you next year. Take care, and if you have any questions or concerns, as always, reach out to us at thorwealthmanagement.com or give us a call. Take care. Subscribe to the Thor channel today.